3, 2, 1. Countdown. Okay, thank you. All right, we're going to get started. Welcome on this extremely snowy day to a fireside chat with the chair of the SEC, Gary Gensler. My name is Andrew Metrick. I'm a finance professor here at the Yale School of Management, and really delighted to have this speaker here. I'm not going to give you his bio because, his Wikipedia page is very long already. A very famous guy who's been doing really interesting things in the finance world for his whole career. And I want to start by just giving a very public thank you to Chair Gensler for his important role in our setting up the Yale Program on Financial Stability here. I don't know if you know about this, but you're incredibly important for the Yale Program on Financial Stability. When I worked I was at a very low-level job in the Obama administration 15 years ago. Chair Gensler was Chair Gensler then too, but of the CFTC, another agency, and was instrumental, we'll talk about this today in one of our topics, was instrumental in the passage of Dodd-Frank, particularly in all of the things around swaps, clearinghouses and exchanges. This is really should be called Title Gensler of the Dodd-Frank Act. And among the things...
Title 7.
Title 7, yes, but I call it Title Gary. And among other things, actually, was very persuasive on how important it was that we move more of the swaps activity, and derivatives, as much as possible onto exchanges, and where that wasn't possible, into clearinghouses, so we could have central clearing of it. Very, very persuasive and expansive in what would get counted as a swap or derivative. Argued ultimately unsuccessfully of getting foreign exchange.
But successfully on interest rate swaps and credit default swaps.
Yes. Successfully on many things.
But not on foreign exchange.
Not on foreign exchange. Ultimately, it got into the law, but then Tim Geithner said, no, I don't want it. But I very much wanted, from my extremely lofty perch, which was not lofty, to get repo, to get more bilateral repo cleared. And we had this idea. I was working at the Council of Economic Advisors, and we knew, along with Austin Goolsbee, my colleague, we knew that Gary was the person people were listening to on this, and even Geithner was listening to you. So we invited you over to wine and dine you one day at the White House mess and convince you what a great idea it would be.
The White House mess is terrific. It's run by the Navy. It's in the basement just a few steps away from the Situation Room. You know that thing you see in the movies and everything where big decisions are made? But the great thing about the White House mess is when you leave, sometimes they will give you some M&Ms or Chocolate Hershey's Kisses with the various presidents. So I don't still have my Clinton M&Ms. That would be really bad. But you could get something with Joe Biden's name on it.
They're just regular M&Ms, but they just have a presidential seal on the outside of the box.
Really, that's what I think about the Navy mess, the White House mess. But what did you do?
We tried to sell, we lobbied you, and you said, you know what, this is a great idea. I really like this. I'm happy to talk it up. Where are the papers that I can cite on this? I mean, I can't just say this is an idea out of the White House. No one's going to care about that. I need stuff. And I said, we don't have anything. And that's because basically the finance profession as a whole had ignored these hard questions for a long time before the crisis. We weren't really thinking through stuff like this.
You usually don't get tenure on a paper on funding the Treasury market.
You don't.
It's called in the repurchase market.
Yes.
So there's incentive systems that don't quite work in academia around that.
That's exactly right. So that's why we set up the YPFS. Because by then I had tenure. And so I said, we're going to do this.
But you weren't burning your credibility.
I have no credibility. Okay, so thank you for that, because you just met our staff and got to hear about the things that we do, and motivation for it was somebody needs to do this stuff when I get, and it might as well be me because I already have tenure and I don't, doesn't matter if nobody likes me.
Geithner still likes you.
And Geithner still, well, you have to ask him today, but as of yesterday, he was still my friend. All right, so I have a bunch of topics that I want to ask Gary, and I'm delighted that since that time I've had the occasional opportunity to talk to you. You went when you were at MIT, and between your your digs hanging out in the academic world and now in your job at the SEC, and it's really delightful. If you haven't met too many people who run stuff in Washington, there's two types. There's the overwhelming type that are really very political, and they're smart, very smart people, but not necessarily that interested in the substance. And then there's a very small number of people, Tim Geithner is an example, and Gary Gensler is an example of, substance people who are stuck in a political world, and those who have really good political instincts can do well there, as you do. So I have a bunch of interesting topics. His speech today, for anybody here who's double dipping, he gave a speech at the law school on AI, and his AI speech had many wonderful movie references in it that touch upon AI in finance, and many interesting Yale Law School references. Must have some good speechwriters who know all about Yale Law School. What I wanted to ask you about, which was less in that speech, but it's something I'm often asked about, and I'm hoping you can give some really good answers that I can then use, is how could AI help the regulators themselves? So are there ways in which, starting with the large language models, but really thinking about all of the places that this technology could go in the medium term, not science fiction deep future, what are the ways that the work of the SEC or any of the banking regulatory agencies or the Fed could be helped by these tools to do their job?
Let me just start by thanking you all for coming together. I know it's a snowy day. I know you've got classes, you might actually be doing your homework and all those things. And so I thank you. I think Andrew is too kind. I met him, he was in a senior role. He was at the Council of Economic Advisors. And I found Austin, who's now the head of the Chicago Fed. But Austin and Andrew always were really, really good judgment, very efficient. When we had a meeting, they went straight to the point and sort of wagged their finger, why aren't you doing this? But it was really helpful. And we've stayed professional colleagues since. He even helped us identify and recruit our chief economist, Jessica Wachter. So a big shout out.
He's great.
For that. But to your question about artificial intelligence, I gave this speech. It was AI, finance, movies, and the law. It may have embarrassed some, but all right. But to your question, I think it's transforming society. It's already, I believe, probably boosted productivity gains in the last 4 to 8 years. Not big numbers. It's hard to tell whether it's 1/10 of a point or 2/10 of a point or something. Maybe you would argue with that, but I think it's already done that and will continue to do that. I think it will transform many things, and we'll see some big job changes, big things that will change in society, somewhat like the 1920s, and you saw electrification of factories and automobiles and refrigerators and everything coming along. It might not be as big as the 20s, but I think it's every bit as big as the internet in terms of, and so that will lead to some really social and political issues as you get job transformation and loss and so forth like that over the next 10 to 20 years. I think there will be collection of economic rents as well, because AI tends towards, because of the economics of networks, the economics of platforms, tends towards concentration. And you're probably going to see, well, we already know, in terms of large language models, there's 3 or 4. I mean, Facebook is trying to compete with their open source model, but the other 3 are all affiliated with the biggest 3 cloud providers. So it's not a surprise that Microsoft and Amazon and Google are kind of adding, this another thing on top of it. So for regulators, how can we use it? Yes, we already at the Securities and Exchange Commission, give you a sense, we oversee $110 trillion capital markets. It's not sort of any shout out or anything, but our whole banking sector is $23 trillion to scale and size it. We're about 5,000 federal employees, about 2,000 contractors. That's roughly what we are. We've already used it, and about 1/4 of our workforce is enforcement. And about 1/4 is examination or inspection, to give you a sense. We already use it in those areas, But I think we could use it if we had the resources, and we're resource constrained. We're about the size in people that we were in 2016 or 17, 3% more maybe. And the capital markets have grown enormously since then. And not just in dollar value, but in terms of complexity and numbers. But if we had the resources, we could use it more. But at our agency, we already use it in law enforcement. I'm not going to say here how. But we've had a couple of cases where we sort of then at the end say, and we want to thank the people in, and then you go, oh, that must have been the folks running the analysis, because we can surveil a market and look for some things. It's pattern recognition. What is AI but math, data, and computational power? And when you pull that all together, you can, the New York Stock Exchange and NASDAQ and so forth can do it as well, but surveil a market for front running or insider trading or market things. But I think we should and ought to use it as well on disclosure review. We've got 6,000 or 7,000 public companies. We have a lot of really talented people doing disclosure review. We have disclosure review also in the mutual fund space and how you sort of do that. How we do examination functions. The bank regulators in similar ways to do their oversight. But you should always sort of expect the government will not be at the cutting edge of any of this. It's just not, it's not how we're structured, and it's not how we compensate people either. And so there's going to be some of that.
Right. Thank you. I should talk a little bit just about format. I've got 4 big topic questions that I'm going to ask the chair to kick us off and get us started. And then we'll take questions from you guys.
I would take questions from you, but you know this is being webcast and everything.
Oh,
so,
yes.
So like, and I might say, well, what's your name? And if you say your name and everything, that means somebody, thousands of people maybe will, you know, so I just don't.
Thank you for the yes. We are webcasting this because that's the law when he speaks.
I don't think
those are the rules.
That's not congressional law, but I just think, look, we have a big responsibility. I think those of us who serve it, it's a huge honor, and I'll one day be a former somebody, nobody, whatever. You know, I'll be out of the job, right? I get a 5-year term. I can't believe I'm serving my 3rd president. But I think it's a big responsibility to make sure the American public knows what we're doing. And so when I do talks, whether it's something like this or other talks, we always just say, it's open to the public. So,
yes.
So people know what we're doing.
But ask anyway. So second thing I wanted to ask you is about financial stability. As you know, I thanked you for the Yale program on financial stability. That's the stuff that we think about here. And typically in the United States,
Are you really the Janet Yellen Professor of Financial Stability?
I am the Janet Yellen Professor, yes. That was an extremely useful title when I was working at Treasury this summer.
I have a question for you. I just you're all ready for this question. Do you guys know this guy? So how good's your Candy Crush?
How good's my Candy Crush?
Yeah.
I'm pretty bad at Candy Crush, I think.
And you're the Janet Yellen?
Is Janet really good at Candy Crush? Wow.
I'm not disclosing anything non-public. She has publicly now admitted to this, like in a podcast. If you haven't heard Secretary Yellen's podcast from about 2 weeks ago, she's really, she can be very humorous in a podcast. But yeah,
she is truly amazing. I'll just tell one Janet Yellen story, which is when I spent the summer working at Treasury after SVB, and she went on a trip to China at one point for a couple of days, you know, economic diplomacy thing. And every step she took in China was cataloged and watched. She was always on display. At some point, someone took a picture of her dinner, and there were mushrooms in it that were like somewhat hallucinogenic mushrooms.
she speaks about this in the podcast, I'm telling you.
You know, it's just constant and 24/7. And every morning, Treasury has a call with all of the senior staff that everybody joins. And I don't usually go to it because it's sort of,
Well, it's too early for you.
it's too early for me, I'm sleeping, you know, that thing. But I said, I want to go to it to see if she showed up at it, because she got home last night. And there she is in her office. She's like dressed, ready for the day. She had just gotten off the plane like 3 hours before.
All right.
It's really
So
amazing.
your second question, financial stability.
Financial stability. Okay, so financial stability, very important. We care about it a lot here at Yale, mostly among the federal agencies. It's the Fed that worries about it. Everyone needs to worry about it a little. for a variety of reasons these days, including the FSOC, the Financial Stability Oversight Council. But traditionally, the SEC has not really cared. And it wasn't in the DNA of the SEC. Pre-Gensler, we would have a little summer camp here for regulators every year, and we'd bring someone from the SEC, and they would spend the whole time telling us how when they go back, nobody cares about financial stability. I think that's changed now under you, and I wonder maybe there's just two parts to the question. One is, what do you see the role of the SEC in financial stability? Like, how should it be conceptualized? And second, is there a cultural issue at the SEC? Is there work that needs to get done to have people thinking about it in the way that you want them to be thinking about it?
So it's a great agency, as I say, overseeing this, getting the capital markets. It's said, written into law, we have a three-part mission. By the way, it's not in one section that it says it, but anyway, you piece it together. Investors, protecting investors, the issuers, meaning capital formation, and that which is in the middle, the markets, fair, orderly, and efficient. I think that financial stability has something to do with all three. I think you can't really protect investors if you don't have an eye on financial stability. What happens when any time we have an event, whether it was the 1929 stock market crash, savings and loan crisis, the 08 crisis, the Silicon Valley Bank, whatever something happens, investors take it on the chin. Issuers usually lose access to capital markets when you have a crisis, and risk premium widen. So how can you say facilitation of capital formation or investor protection doesn't have some investor, and issuer focus on stability, but then right in the middle, the markets, fair, orderly, and efficient. That's the words we use. It's written in orderly. So I got to the job, a former colleague, but also, a really great economist. He's actually went on to win a Nobel, Ben Bernanke, said, Gary, you might want to say what you think about that. Ben and I had gotten to know each other. He actually was, when I got tapped for the job, he was up at MIT. He said, you might want to let people know what you think. I said, it's not hard, Ben. I mean, this is not a hard thing for me to, so at the first Financial Stability Oversight Council meeting, and a little note, we meet in this public setting. It's very formal and so forth. But in my 300 or 400 words, I decided to say some of this publicly. I just think it's right in the middle of it. And so we've taken on 50 to 60 policy projects, the rulemaking projects. And of them, 15 to 20 are around the financial stability side. There are about registered funds like money market funds and open-end funds, which money market funds today are about $6.5 trillion. They've grown a lot since Silicon Valley Bank, up about 30%. But the other funds are about 30-ish trillion. Private funds, which are in aggregate 27 trillion. Note that private funds are larger collectively than the entire commercial banking sector. We've taken up some projects there on data transparency, particularly. The whole Treasury market project that we're embarked on with Secretary Yellen and Chair Powell and some help from the New York Fed and the CFTC and so forth. We've got like 5 different projects there, but particularly about central clearing in treasuries, the registration of dealers in Treasury, the registration of the platforms. We've even done a project, it's adopted but not implemented yet, to shorten the settlement cycle. And it sounds like maybe a little bit boring. It's the plumbing of the markets, but time is money and time is risk. And if you shorten from 2 days to 1 day. And then we've taken up a variety of cyber resiliency projects. So, it's sort of this suite of resiliency. I'll say one thing about shortening the settlement cycle. So, like, President Biden, 2 days before he takes the oath of office, announces that I'm going to be heading the SEC, or I'm his designee. It was cool. Don't get me wrong. It's really, and then a few days after he takes the oath, the GameStop events happen. How many of you remember that? Okay. And so that all happens, and because of the clearinghouses, one thing that was happening in there, the clearinghouses said, we no longer can let people buy more of these various securities because they were so volatile, and the clearinghouses were at risk that they said to Robinhood and others, no mas, no more. And so then investors, regular investors, were kind of shut out. And so in that big hearing that then Chair Maxine Waters had a month later with the head of Robinhood and I can't remember the name of the person who was the Reddit investor was there, and all these other investors, Ken Griffin from Citadel were there. A central question of that hearing was the settlement cycle. I go through my confirmation hearings the next month. Settlement cycle. It became like the topic du jour. So we took that on, and Memorial Day weekend, we'll go to 1 day versus 2 days. That means if you sell a stock on a Monday, you'll get your cash on Tuesday. So, but it's plumbing.
Yeah, it's very important though.
So.
Thank you for that. Next question, you talked a little bit about cyber. I want to ask you kind of a big picture issue about cyber. I know that if you read, follow along the press stuff, as far as I can tell, the only thing that matters in the world is cyber. Bitcoin ETFs were the biggest story in the whole financial press for the longest time. But I wonder, taking away from kind of specific rules and things, whether you have a view on what the digital finance ecosystem might look like 5 years from now, 10 years from now, assuming that all of the regulation works out the way we hope. What's the use case? What do you see as being the important changes in financial innovation?
How many of you, by a show of hands, have used paper currency in the last 24 hours? Wow, more than I would have thought. For the looking audience, 3/4 did not raise their hand, 1/4 raised paper money. We already live in a deeply digital money system, right? You pay your tuition online, you pay your rent online, you get paid we transitioned to digital money 3 decades ago, basically, but by now, really deeply. There's no such thing as a physical treasury certificate. It's illegal. $27 trillion treasury market is all digital, 100%. And the stock market is basically 99% digital. I mean, my dad, Sam Gensler, did have physical stock certificates, but we don't have those any really longer, unless you frame an old one and put it on a wall. So we have digital finance, and what we've also have is an interconnected global digital financial system. So something as a statistic I find really important to get to your question. We're 23% of the world's economy, but 40% of the world's capital markets. So we're punching above our weight class, which what hegemons usually did. The Dutch and the Brits before us did in their centuries of being hegemons. So you ask about the future. I see that we're already fully digital, so it's hard to say we'll get more digital, but the trading on our stock exchange, which has been fully digital for some time. The New York Stock Exchange, if you go on the floor, how many of you have been on the floor of the New York Stock Exchange? What's your name?
Christian.
Christian, how would you describe the floor of the New York Stock Exchange? How many people did you see on there?
Not many. It's pretty desolate.
Yeah. It's basically a stage set. It's sort of like, if you go to a movie studio in Florida or in California, it's a stage set. When I started on Wall Street, it was like teeming with thousands of people. And why does Intercontinental Exchange keep it? It's largely stage set, but NASDAQ, you don't have a floor, for instance. But I think what you're seeing now in the credit markets and fixed income, more intermediation, and I think the next 5 or 10 years you'll see the corporate bond market, the municipal market, even mortgage market be more on these, and that's partly why we want to get these alternative trading systems registered in the Treasury and fixed income space. I maybe went a different direction. Maybe you were trying to get me to crypto, but
No, it was really less, it's not so much what everyone calls crypto, but I should say decentralized finance, the use of the blockchain. Is your sense this changes everything, or is this more of a small piece of the pie?
No and no.
Okay, good. That's a quick answer for that one. All right, so my fourth big topic.
Let me just say, finance since antiquity tends towards centralization. And there's a lot of economic, I'm at a business school. Earlier today I was at the law school. My God, that building is like Hogwarts. This building looks more like MIT Sloan. I get that, I understand that. I don't understand Hogwarts. Like, that's really beautiful over there. But what I want to say about this is finance goes to centralization because it's about the economics of networks. It's a bit about the economics of data. And look, even the Medicis had an advantage because they could collect the best data. JP Morgan, the human, not the company, had advantages in the late 19th century because he could centralize the key data and make better underwriting decisions based on that data. There's all sorts of economics of finance that may or may not be taught here, because you usually have faculty that talk about platforms and networks, and the students that take those classes, because I was at MIT, all want to go to tech land, and they want to create. They want to be the next Jeff Bezos, right? You want to create those types of networks. Well, those same networks exist in finance, and it's also why in China the biggest tech firms are actually in finance too. Ant Financial, and et cetera. Here in the US, it hasn't quite transitioned quite the same way. But so I just don't, with all respect, see that a couple thousand years of economic history is going to be transformed because you have a new accounting ledger. Blockchain technology, I taught it at MIT. It's novel. I'm sorry. Does anybody know who Satoshi Nakamoto is? Show of hands.
I thought nobody knows who he is.
Wait a minute. Adam, who is it? Who is she or he?
Creator of Bitcoin.
Oh, we're fine, but who is she or he?
Unknown.
I know. Do you know? Does anybody know who Satoshi Nakamoto is? That's my question. Listen to that. On Halloween night in 2008, on a cypherpunk mailing list, somebody posted an 8-page paper about how to move value on the internet, and we still, 16 years later, don't know who she is. Or the team of, right? 8-page paper. It's really a nice bit of computer science. It really is about how to have a distributed, decentralized trust system for an accounting ledger, for recordation. Now, you can use an Oracle database as well, but this is a decentralized thing you could do. But I don't think that changes finance. And 16 years later, point out where somebody's using it. If you look at the major crypto companies, they are not using blockchain technology to keep their books and records. None of them are. The token operators might be, and the major use case for tokens is speculative investing, plus illicit activity.
Not necessarily in that order.
The dominant market share of the illicit activity is still just using 1 or 2 or 3 tokens. So.
Yeah. So last question before we open it up is, I started this by talking about the work that you did in Dodd-Frank, which I saw up close. And I wonder what you think now, more than, well, no, not more than, but almost 15 years later, almost 14 years later after passage, how well did taking the parts of it that you spent the most time on, how well did that work out relative to what you hoped? And what do you think the unfinished business is there that we should be thinking through for the future?
So I was honored, asked by then President-elect Obama to get involved in this agency, the Commodity Futures Trading Commission. How many of you have heard of that agency? it's kind of the Rodney Dangerfield of agencies. You don't know who Rodney Dangerfield is, but right. It's a great agency. It's a really great agency. I'm referencing a comedian who always used to open up saying, "Get no respect." It's a really great agency, oversees the commodity derivatives markets, so to speak. So I was involved in this thing called Title VII to bring that which had been unregulated, the swaps market, into oversight. The futures market, how many of you know what a derivative is? A financial contract that derives its value from some reference. Derivative derives its value. Futures is a form of derivative. It was initially on corn and wheat and grains that was regulated in the 1930s, same time the SEC was set up. But then a whole bunch of other derivatives came around, and they were called swaps. So there was this arbitrage. So in Title VII land, I think that's largely been successful, and you can see in a couple of ways. You can see that it got us closer to all trading. It drove a great deal of efficiency. If you look at the spreads, the bid-ask spreads, in the interest rate swaps markets, they really came down dramatically. I think we've also, and another way you can measure it is risk. I think instead of having all of the spaghetti wire of bank-to-bank bilateral relationships and bank-to-customer bilateral relationships, you brought things into this thing called central clearing, which is like this one innovation of like the 19th century that actually still exists and really does substantially lower risk because you have something called multi-party netting. It's about the math, and it brings down risk. I think those have, I mean, there may be work and Chair Benham is doing it and all those things. There may be more work, but I think it's largely worked. The rest of Dodd-Frank had set up a whole Consumer Financial Protection Bureau. And I think that was important and consequential. I think that it sort of addressed things about the banking sector as well. But I would say this, since antiquity, finance tends towards centralization, and those central intermediaries always retain some risk. They retain risk as a business model. Ultimately, if you can manage volatility, you get paid for it. And when I was at Goldman Sachs years ago, some of the sayings was that darkness was our friend, meaning lack of transparency. A dealer benefits economically from opaque markets more than transparent markets. And the markets benefit from transparency rather than opacity. Right? So it's sort of a interesting public policy tension.
Yes.
But also, you would find that volatility can be an intermediary's friend if you survive it, if you manage it well. Of course, banks also have this thing called maturity transformation. And so thus, why do I raise that? If you have volatility and risk and maturity transformation and operational risk in the middle at big intermediaries that tend towards concentration, they will from time to time fail. And my dad's little business had no more than 30 or 40 employees in it. But if he failed, the city of Baltimore was never going to bail him out. There's no way. If he didn't make payroll on a Friday. And yet somehow, you get to situations like Credit Suisse is on the ropes. And the government of Switzerland, obviously looking out for their citizenry, they're looking out for their, 8-9 million Swiss citizens. They're saying, no, we've got to do something, and they do the arranged marriage with UBS. So we haven't repealed that.
Right. We haven't repealed that there's still risk in the financial system. It's going to sit somewhere.
And there will be. And
yep.
I joined Goldman Sachs in 1979, so I can say this 45 years ago. It's because Yale Law School waitlisted me. It's true. I'm still waiting to hear from that admissions team. But life worked out. But I'd say this, in those 45 years, I've seen my share of financial stability events, the savings and loan crisis, the my God, Solomon Brothers bid rigging sort of little scandal thing, and on and on. I was asked when I was a treasurer to go up to long-term capital management on a fateful weekend, and in 1998. If you have a 45-year career and if it's in finance, you'll have your 4 to 8 financial jitters, crises, whatever. I don't think we've repealed this stuff.
Okay, questions from you guys?
The floor is open.
Floor is open. Yes.
Just tell me your first name and then tell me your question.
My name's Ben. Thank you for coming.
Sure.
I have a question. You talk a lot about centralization and digitization of a lot of these markets. Can you talk at all to the risk of quantum stuff, sort of throwing a wrench in encryption and sort of the safety of those markets?
I'm not as close to it today as when I was at MIT, so I'm a little dated. And a lot of developments in those 3 years. But I think one has to sort of plan for, if you're a big bank or a big clearinghouse or anywhere in commerce, you've got to plan that quantum is coming. And I don't know how many of you know about cryptography or know enough about cryptography, but it's about math. And and it's a lot about one-way formulas. This math that a two-way formula is like adding and subtracting is 2 ways because you can reverse engineer it. Multiplication and division. But one-way math you can't quite do. And so the problem with quantum is you can use brute force to break any cryptographic approach. And so I think people just have to plan for it. And then all the hash rates and everything that's used right now, even this live broadcast is using cryptography to do the link. Will have to be updated. I believe, and maybe I'm the optimist, I believe the real issue is not whether we'll have cryptography, because I think you can have quantum-resistant cryptography. The real thing is the transition. And so when we get to that point and somebody starts breaking all the cryptography of that moment, and whether that's 2028 or 2036 or whatever day it is, when somebody's breaking all those things, there's the mad scramble to the other side. And that's a financial stability issue in that transition. Thanks for the question.
Thank you. Yes.
Hi, thanks for coming.
My press shop is probably going, he wasn't prepped for that.
My name is Wesley, and I had a question about, I guess, the financial stability implications of a lot of lending moving from the public markets to private credit and loans in that space.
So it's a really good question. I was meeting with Andrew's colleagues before this. They asked a similar question, his faculty colleagues. Here in the US, we do private credit intermediation more significantly than any other country. And depending upon different measures and a dollar weighted, that's 70 to 80% of credit intermediation is actually in the capital markets rather than the bank sector. And in Europe, it's the exact opposite. In Europe, it's about 70 or 80% in the banks and 20-ish% in the capital markets, give or take. Japan, China are closer to Europe, but a little bit better. And I think that's benefited the country. It probably has a smaller footprint of the commercial banking sector and a bigger footprint of capital markets. It doesn't mean there can't be financial stability events in the capital markets. There are. I think that if I can grab an intersection to it, it's also AI is going to change some of this. We've already seen this in China, but there's a lot of credit intermediation at Ant Financial and elsewhere using predictive data analytics, basically, to do SME lending, small, medium-sized enterprise lending. Here in the US, I think that transition is behind where they are for a lot of structural reasons. Their banking sector wasn't as well developed as ours. But I really do think it'll be interesting to see over the next 5 or 10 years what happens if the data that you can discern, and it might be private as well as banks, but if they have the good data coming off of whatever data source for small and medium-sized enterprises to better do underwriting and risk management, that could shift. And I think that's the bigger shift than the actual capital markets. We could see it in underwriting, credit underwriting. And what I don't know is, will that be led by non-banks or banks? I have a hunch it's a race to be, competed. I don't necessarily think that. Maybe you do think, which will be ahead, but I think AI will start to shift this as well.
Thanks. I think there was a question in the back. Yes.
Hi.
It's all yours.
Many of SEC's recent rules have had some challenges, and
It's part of our democracy. No, it's a great system, democracy. It's a little messy, but,
so I was wondering, like, how would you navigate this, more skeptical judicial landscape about your rulemaking agenda?
Look, I believe that we are best as an agency when we do things within the law and how the courts interpret the law. I think that for numerous reasons, I really do believe in the rule of law and our constitutional system, but I also think it's a way to have sustainable rules, that which will help people's lives and markets for years to come rather than just be overturned in court. So it's a deep, kind of both value but also policy thing that I believe. You're mentioning that, the courts we might be in a transitional period of time. Not as dramatic as that quantum computing question got. But, we might be in somewhat of a transitional time. So anybody in a job like mine or members of 5-member commissions, whether it's federal trade, federal communication, et cetera, the Fed board, is conscious as that might be a transitional time because that which is black letter law or that which courts had, either given deference to or done thumbs up in the past might be shifting. And that certainly makes the job more interesting. But I sort of me personally root it as what's the law and how have courts in 2024 interpreted the law. And when, like recently, you asked this question about the Bitcoin exchange traded product. After a couple of dozen times, it started under my predecessor, Chair Jay Clayton, we had disapproved certain filings of stock exchanges to list these products. A DC court said no, they didn't accept that. I thought that the most sustainable path forward was to approve the next set of filings, given the courts, as I believe in the rule of law.
I think it was less than 24 hours between the approval of that and the appearance of ads for those ETFs on every subway platform in the world. It was amazing how fast they were ready to roll out the advertising. All right, Elvis, you've been patient.
Chairman Gensler, yeah,
That's really his name.
Chairman Gensler is really grateful for joining us. And as a Chinese concept stock investor, I think you are the most popular SEC chairman in China.
China? I mean, there's 1.4 billion people there.
Actually, you did because what you did is you achieved the PACOB, achieved enhancement with Chinese and Hong Kong auditor, and this is really great achievement because your former colleagues cannot achieve it in the last 15 years, and you achieve it when you are onboarding this chairman just in 1 year. So it's really saved a lot of investors like me. And also, it's a mark of the Chinese concept stocks and the surviving because of this achievement. But I have a question about, do you facing a lot of regular challenge and
The regular what?
regular challenge the challenge from regulator and the policymaker, and also the diplomatic challenge during this achievement. And also, do you think your background about the Sarbanes-Oxley really help you to achieve this achievement because you are the
You mean the
policymaker?
achievement with the Chinese authorities?
Yeah, also you are.
Well, let me give you a little background. Many of you wouldn't know, and so I just set the stage. We had a bunch of problems in the markets around a company called Enron and others. There were accounting problems. And this led to a law called Sarbanes-Oxley in 2002. I was honored to advise Paul Sarbanes, my home state senator. So I think it's safe to say I helped write that law. Not with others. I mean, it's always a group effort and team, but I was senior advisor to Senator Sarbanes. I found myself taking on this job, the current role in 2021, and having to relive Sarbanes-Oxley, the law that Senator Sarbanes had helped lead with Mike Oxley, Republican from the House. One of the debates we had, and I remember, was like, how would it apply to foreign issuers? Would foreign issuers tapping into the U.S. have to have their auditors inspected by a U.S. agency? It was one of the issues. There were a lot of other issues. And Senator Sarbanes said yes. I remember sitting in that conference room. He had a glass full of ice. Paul always loved to chew on ice. And he said, it's U.S. investors. We have to have the same protections. If people want access to the U.S., they should have to have their auditors inspected. Okay. So I come into a job 20-some years later, and one country around the globe has not complied with this, China. And it had gotten so under the skin, the policy skin, and the political skin of my predecessors that Congress had passed a law a few months before I came in called the Holding Foreign Companies Accountable Act. It was in the Trump administration, Steve Mnuchin, Jay Clayton, others. But interestingly, a Democrat from my home state, Chris Van Hollen, and I think Chris might actually have been in Paul's seat, so I think he was his successor in that seat, working with a senator from Louisiana, John Kennedy. They couldn't be more politically different in terms of their views and thoughts, came together and got that Holding Foreign Company Accountable Act passed. So that's the stage. I come in. 50-plus other nations had allowed it. China had not. And Congress had passed this law that said if somebody doesn't allow it in 3 years, they've got to be kicked off the U.S. capital markets. So I came in with something my predecessors didn't have. And my predecessors didn't have that leverage. I had leverage. So, Elvis, I have to say, in fairness to my predecessors, well,
But he really wants to reach you.
no, but I'm turning it off. The sound's supposedly off. So we had leverage, and it's really Senator Kennedy's, Senator Van Hollen, and many others in the House and Senate in the Trump administration that we had that leverage. But what I also, and Secretary Geithner, and Secretary Clausen, and Secretary Clinton, Hillary Clinton, like I asked them early in my term, like you've negotiated with the Chinese authorities, how they all stressed respect, dignity. They all stressed also that even if you're going to be successful, there will be a tough end game, that somehow the negotiation near the end will be, it was just interesting. These really incredible leaders early on could say, look, but respect. And I remember also the importance of consistency, they said. Now, our system of government is different than China's, but I think there was a little bit also of explaining what our system of government was and is. An unusual circumstance was that ultimately I was the senior decider. We're an independent agency by structural forms, and we don't report to the State Department, the Commerce Department, or the White House. I think that took a little while, or even the Treasury Department. That took a little while in negotiations, but I think that also advantaged us, that they realized they were dealing with a deciding official rather than, how to sort through. So we laid out in August of 21 in that first meeting 4 principles that we needed, 4 key principles that we needed in an agreement. We got to that agreement about a year later, but we never strayed off those 4 principles. Chair Yi, who was on the other side, and there was a somebody from the Ministry of Finance who was quite senior, we just stayed consistent, respectful, and they understood that also I would work with them if they were to have their 200 companies leave the US capital markets. And I really said, I respect, it's your choice. You can stay in the US capital markets, you can leave. I'm sort of by my job neutral to that, but I want to facilitate whichever it is, but we've got to get these 4 things in this agreement. It may have helped a little bit that I started that first meeting and told them that my dad had served in China, defending US interests in China in World War II against Japan. So there was kind of also this thing that happened in that first meeting that may have just credentialized that, something about that. But I really said to him, look, if 200 companies leave the US, that's your choice. We're here if you want to meet these 4 conditions. And ultimately they did. And I think it's partly because when you're the deepest liquid capital market, 40% of the world's capital markets, the Chinese authorities ultimately decided, no, we want to continue that access. And we facilitated that by being, clear on that, but respectful. I think.
Yeah, thank you.
I didn't get these sides of the room, so. Marty.
So in your opinion, what do you think is the biggest risk for financial stability? Why?
Well, before today, I wasn't going to put quantum on there, but when is that going to happen?
2028?
Oh, my.
2028. That's going to be a really tricky transition. But you're saying before 28?
Yeah, I mean, what do you think?
Look, here's the thing. I'm going to start with something about age. If you walk on a trading floor in London, Frankfurt, New York, Tokyo, you tend not to see anybody over 40. That was true, by the way, when I joined Goldman Sachs in 1979. That hasn't shifted. In fact, my mom said to me when she visited in 1980, I said, what do you think, Mom? And she says, this isn't a career. I said, and I was 22. And I said, why? She said, I can't see anybody over 40 on any of the floors. I'm worried about your career. And she was right. I left at 39. Jane Gensler was a wise woman. But I'm going to start there. We've had about 15 years of central bank intervention in the sovereign debt markets and the interest rate markets in a way that we didn't have pre-08. I mean, all the central banks around the globe were intervening, in a sense, in the short interest rate markets, Fed funds and the like. But country after country, under Bernanke and Mario Draghi and others, Mark Carney, they did what was called quantitative easing of some sort. You studied it more and study it more. Now, as we've receded out of that, all those bond traders have no muscle memory trading in the markets we have today. I haven't seen the rate moves today, but look at the volatility we had today with some inflation reports this morning. Do you know what they moved at the end of the day? How many basis points?
10-year was at 430.
What's that?
The 10-year was at 430, I think, by the end of the day, which was 15 basis points higher than yesterday.
So the 10-year moving 15 basis points from 2009 to 2000. 22, a 15 basis point move was like not even once a year. And now it's like once every 6 weeks or something, or maybe more often, I don't know. And a year ago, after the Silicon Valley Bank events, we had the biggest moves, volatility in the treasury markets we've had in 35 years. So I think that's just an interesting contextual framework that we have more volatile interest rate markets as central banks have receded out of the QE. And then I couple that with the amount of leverage that banks are providing non-banks. And there's various surveys, public surveys that we've put together, the Fed and the Treasury put together. A very significant amount of the funding of the macro hedge fund space is being provided by banks at near or at zero margin, which means leverage. And so, it kind of works until it doesn't work. That's what I raised.
All right, time for one more question. Let's go, Salil.
Thank you, Chair Gensler. Just pivoting from cyber, what is your thinking around climate as a potential?
Wait, that wasn't a cyber question.
As in, just from the earlier discussion, what about climate as a financial stability risk? You have mentioned proposed some rules over disclosure requirements for companies on emissions. Do you see that as a major risk going forward?
Let me say something about this, what the SEC's role is and what it isn't. We're a disclosure-based agency, but we're merit neutral. And this was actually debated when we were set up. So we are not a climate regulator. We're not a climate risk regulator. But we did make some proposals March 2 years ago around trying to bring some consistency to that which is already happening. You actually look at the top 1,000 companies by market cap in the US, kind of the Russell 1000, the vast majority, maybe about 90%, are making some climate risk disclosures. About 50 to 60% are disclosing greenhouse gas because investors are demanding it, and through we had a 2010 guidance, but also through sort of normal ordering, investors demand, issuers are doing that. So I look at it as that we have a role to play to help bring some consistency, and that drives efficiency in markets when information can be comparable, it's more decision useful. But we are unambiguously not a climate regulator, and it actually doesn't matter what my view is on the question you just asked, because it's not what I'm paid to think about.
All right, well, thank you very much for extending your day at Yale to come over to the School of Management.
Absolutely.
Appreciate it. Thank you. Thank you.